It's mid-2026. The post-inflation dust has settled, you've analyzed your ERUSD swing trade, but suddenly you're stopped out by a random 5-minute liquidity spike. High-liquidity major pairs have become a playground for institutional algorithms. These programs use refined stop-hunting logic to clear out retail positions in crowded trades, essentially harvesting liquidity from the most popular setups. Traders often mistake these sharp moves for profit opportunities, but in this specific era, that volatility is usually engineered noise. It functions as a trap for those following traditional swing strategies. Long-term success now depends on moving capital into secondary pairs. These crosses lack the massive, concentrated liquidity pools that institutional algorithms need to execute large-scale stop runs, allowing fundamental trends to develop with significantly less artificial interference. The analytical alternative to chasing wild swings is a metric called trend persistence. This is the statistical tendency of an asset to maintain its direction over several days, without those erratic, mean-reverting snaps. This chart shows two price paths. Pair A moves 100 pips up, 80 down. It's highly volatile. Pair B moves 20 pips up daily. This offers a distinct advantage. Your P&L isn't swinging wildly, preventing emotional fatigue, and your transaction costs drop dramatically. You can verify this behavior using specific technical criteria. Look for an average directional index, or ADX, rising above 25 on your daily chart, paired with consistent higher highs on the 4-hour chart. Filtering for this specific mathematical consistency is the foundation of a modern swing trader's edge. You are no longer trading movement, you are trading persistence. Finding that persistence requires our first systemic filter, shifting focus away from the US dollar toward commodity crosses, like the Australian dollar against the Canadian dollar. Australia's economy is heavily driven by its role as a global powerhouse for lithium and rare earth minerals. These are the exact materials fueling the 2026 surge in green infrastructure spending. Canada, by contrast, remains heavily anchored to traditional energy exports and a robust industrial manufacturing base. When global capital flows heavily into green infrastructure projects, the Australian dollar naturally outpaces the Canadian dollar. That friction creates a smooth, highly persistent uptrend for the pair. By trading these growth proxies, you sidestep the unpredictable daily drama of the US dollar and lock into the clear, long-term momentum of global infrastructure cycles. The second filter involves central bank policy divergence. The era where every currency pair moved in lockstep with US inflation data has ended. Instead, individual banks are decoupling. The European Central Bank is currently navigating localized economic slowdowns, while the Bank of England is actively battling sticky service sector inflation. These contrasting policy paths, visualized in their diverging interest rate projections, breathe persistent trends into previously ignored crosspairs, like the euro against the British pound. Tracking actual central bank decoupling provides a clear roadmap. It allows you to trade the major currencies based on macroeconomic reality, isolating you from intraday algorithmic noise. There is one final structural advantage in this market. Central banks have reached a terminal plateau, holding interest rates at distinct elevated levels. This has revitalized the carry trade. When you buy a currency with a high interest rate against one with a lower rate, you generate positive swap. This is a passive daily income paid directly to your trading account simply for holding the position overnight. Math time. At 1.5 pips a day, a 10-day hold generates 15 pips of passive profit. With a 60 pip stop loss, this 15 pip head start widens your safety net. The market must now move 75 pips against your entry to trigger a loss. In a swing trading strategy, positive swap serves as a structural risk buffer, widening the margin for error against intraday volatility. Identifying a structural trend is useless if your execution relies on a static 30-pip stop loss. You will likely be taken out by routine liquidity spikes. You need to calibrate your risk to current conditions using the average true range, or ATR. This tool measures the exact historical volatility of your specific currency pair. Setting your stop loss at 1.5 to 2 times the daily ATR allows the trade to survive the random noise of the London market open while keeping your long-term thesis intact. Dynamically scaling your risk parameters to match the asset's actual daily movement is what separates a calculated professional thesis from a vulnerable gamble. There's one final trap to avoid: correlation clustering. Many traders assume they are diversified by going long on EUR-USD, long on GBP-USD, and short on USD-CHF simultaneously. In reality, they've placed 3 identical bets against the US dollar. A single unexpected US macroeconomic event will trigger simultaneous stopouts across all 3 positions. A resilient divergence portfolio balances distinct themes. You want one US dollar proxy, one commodity cross like AUD-CAD, and one policy divergence play like EUR-GBP. You can audit your current watch list using the FXNX correlation matrix to identify hidden systemic risks. Once your portfolio is balanced, start executing these high-persistent setups using FXNX's zero-pip spreads. Stop trading the noise and start trading the